Hello, I'm Brent Wilsey, and with me is Chase Wilsey, and today we're going to mix it up a little bit. We're going to talk about the newsletter. The newsletter comes out every Tuesday. In that newsletter, we dissect a company or give you more detailed information, so you'll be able to get that news that'll be attached to this post here, and you'll be able to get more details at our website. On today's newsletter, we're talking about Norfolk Southern. Norfolk Southern is a railroad. Now, it's not very exciting or sexy, but it's a railroad that, again, I'll keep you on track, put it that way. They have over 20,000 miles of tracks, so they're a big railroad, not a tiny one. And what's really important about this company is they have earnings. For 2017, they're expected to make $6 per share, and that will give you a PE of 12. Now keep in mind, the S&P 500 right now is around 19 to 20, so a forward PE of 12 is it's a very good value, don't you think, Chase?
Yeah, I mean, we always say we like to buy companies with a forward PE around 10 to 12. That still gives us room for them to grow and hit the average forward PE of 16.5. So here, Norfolk Southern, symbol NSC, is looking pretty good in that regard.
Yeah, good one for you to look at. I also want to talk about something that really irritates me, and that's target dated funds. This is the biggest hike from Wall Street to get you to do something to try to target your retirement. And these are funds that you pick a retirement date. So if you're going to retire in 2030, you would pick that target date as 2030, which would be up to 14 years from now. But what I don't like about them is they're a mixture of stocks and bonds. Now right now stocks are very low and bonds are very high. And what happens, because you're closer to your retirement date, your bonds will be a portion to bonds and very little to stocks. Not a great idea.
Yeah, I mean, the target date fund is based on this idea of asset allocation and risk tolerance, and the older you get, the more bonds you have to have in your portfolio, but we think that's craziness. Why do you want to have bonds in your portfolio when you know it's going to be a depreciating asset? Just doesn't make any sense to me.
And what I want to point out too is the best 1 year return for a 2030 target fund was 0.17. That's for 2015. That's the best fund that they have for that. But look at the worst one. They were down 5%, and this is probably the best time for them because why? They're most quote-unquote conservative. So stay away from these target funds. What really worries me is that the 401k market, 14% of the assets are in these terrible target funds.
Yeah, and a lot of that is because people aren't really sure what to do with their 401k investment, so they think the target date fund is a good investment. However, that is improper education, we believe, and they need to be making smarter decisions when it comes to investing in their 401k.
Right. So not a great idea. If you have target funds, give us a call because they're not a good idea. Brings me to 401ks. 401ks are something that, if you don't have 401ks or you're not investing into it, you need to have one. Ask yourself this question: do you want to retire? Well, if you want to retire, you should have a retirement plan, and 401k is the best plan you can have. You get a great tax deduction for it, and maybe, just maybe, your employer will match it.
Yeah, and it is very important to save for your 401k, and I was doing a little reading today, and hate to break it to most people out there, especially people my age, Social Security I don't think will be as strong as it is today, and currently retirees depend on 1/3 of their income as Social Security. So it is crucial to be saving your 401k so you have income in retirement.
Right, and again, a 401k is something that if you have one at work, make sure you add to it. If your employer matches, that's great. It's like free money that you get because your employer will match it for you. So looking at your 401k, and it's the best investment ever, because people think, oh, a house is a great investment. Not really. When you send $1 ventures to the bank, you get a 30-cent deduction after the 30% tax bracket, but you invest in a 401k, for every dollar you put in, you get a $1 deduction, and you get to keep the money.
Wow, that sounds amazing.
Right. Well, I hope that's been helpful for you. If you have any questions, as always, feel free to give us a call. You can go to our website as well, smartinvesting2000.com. Our phone number is 858-546-4306. We're here to answer any questions you may have on investing. We also do 401ks at Wilsey Asset Management to help out your employer if you don't have one. So give us a call, contact us.
And don't miss any upcoming daily briefings. Join our group, Smart Investing with Brent and Chase Wilsey on Facebook.